Hello, everybody. This is Noah and John, and we are from Urban Digs, and we are going to discuss a very timely topic today, Johnny. This is something that you and I have been internally debating, and we have a special guest. We got Ben Willig, sales manager over at Elegran, and he's going to join us with some interesting thoughts on this topic as well. And what we're talking about here is rates. We're talking about here is interest rates and the move in interest rates, its effect on our market and whether or not there is an effect or what's going on with prices, with activity, et cetera, et cetera. And I just wanted to lay out, I'm going to share my thoughts first, and then Ben, I'm going to hand the torch to you, and we're just going to go around the horn here. And what I think is going on, first off, there is incredible activity going on right now. Like, it's just incredible. Like, what's going on right now in the Brooklyn sales market is incredible. What's going on right now in terms of contract activity for the Manhattan markets is incredible. And what's going on right now in the rental markets is incredible in terms of activity right now. A lot of brokers are surprised. So in my opinion, what I think is going on is I think that you're having not only the peak activity that typically happens around this April, May period, but you also have a pull forward of demand, which I think is adding to the activity and the urgency, the feeling of urgency that's going on right now. And I think that there's a lot of buyers out there that probably were planning on buying in May, June, July, or August, or whatever, and they've decided to pull forward that purchase. And you're seeing them active participants in the buyer pool now for our markets. And that's what's contributing to it. And I almost would describe it, John and Ben, I would almost describe it as like a sugar high, followed by what I think is going to be a sugar low. So my point is similar in 2019 when we had the mansion tax, and that was a date, July 1st. If you close before it, you're good. If you close after it, you're bad. We had a demand pull. And what we did is we saw activity rise and prices rise before, and then right after, activity fell and prices fell. And then we had to wait another couple of months for it all to normalize. So the sugar high, the sugar low, and then normalization. I think we are in the sugar high portion. And if I had to describe the timing, I would say, come June, come July, come August, we'll probably be in that sugar low. Ben.
So I guess just to be slightly contrarian, but from a lot of different anecdotes from people I'm getting, in the field, I think you could maybe even compare this to, more of just, a deer on the highway, right? I think what we're going through right now is maybe a little bit of that, just like initial shock, right? Is we've for 30, 40 years been in one type of, rate environment and everything like that. And we're moving into this time frame that's a completely new norm. And with any time you're moving into new norms, there's lots of uncertainty. So there's a lot of pauses and, cause for concern and things like that. I think there's about 4 or 5 different factors that I'm seeing across the board in the, rest of the country from my conversations with, managers who manage tens of thousands of agents across the country, developers here and clients here. So kind of sit in an interesting position of being able to see a lot of that. And, one, everything I've gotten from across the country is that the, let's call it return to urbanization, might be coming back a little bit more. The suburb markets have cooled from like those 15 offers or so down to like those 4 or 5, offers, which is kind of a massive slowing when you look at, things out there. And we're still getting a lot of those people coming back, to New York City on that front. I also just, multiple calls and agents kind of talking today, clients who, were going to look for a rental. I actually talked with, one of our agents, Sharon Stewart, this morning, stayed in their place last year, contacted her this year, and rents are high. So they're just going to buy instead. Right. And so now you have, with this very, very hot rental market, you have new buyers coming to the market with that, because even with the high rates, it still makes more sense with where those prices are going to buy. Plus, on top of it, one of, I think, the other factors is for the first time, since I've been working in the business, we're actually seeing real wage appreciation. I mean, from when I started on, Wall Street, I was still seeing the same type of offer letters up until, the last couple of years, and that's over a 15-year period. So, now we're actually seeing, even administrative assistants get $20,000, $30,000 bumps, in their salaries and things like that. So what they can afford on these rents and apartments and to buy, is very different. And I think when people realizing that maybe we're in this, new norm, it still makes sense to buy. My asset prices, are going up. As this kind of continues and perpetuates, there's a big, constraint right now that I'm seeing with my developers because their costs are going up. Land acquisition is still high. The ones who are currently in projects are getting, slammed with costs going up on them, and it's not becoming as economically feasible. So if there's less supply coming in the future, I mean, I think we all agree long term we're going to see these, these prices going up. But I think a lot of the consumers might be driven by those investors who want to snatch up supply in the sales market because of the rental market. And then you also have those New Yorkers where it just makes more financial sense for them, long term to do that. And we're in this sustained higher level, of demand. But we're at a crossroads. And so I don't disagree that, is it a sugar high and low? Is it the initial shock of a deer being in the road? So hard to say how all these factors I think are going to play out, but I'd be curious what John thinks here.
No, Ben, thanks. I mean, I tend to agree with you, and I do have some agreement with Noah. It's not really a debate, as in like one or the other. I think it's shades of gray here.
Exactly. Yeah.
I mean, look. So if we took a deep look at the mortgage market as a comparison to Manhattan real estate, and really the correlation is very weak. If there's any correlations on the jumbo side, jumbo rates have just crossed over 5%. So there is kind of now a new sort of thing going on. But again, if you've got a relationship with the bank, you could probably knock that down a few basis points. So you may still be under 5. But that being said, things are more expensive to own. But on the same side, as you mentioned, rental prices are just going crazy right now. And yes, I think the days of 30% year over year appreciation are probably done because we were sort of, comparing a peak to a trough, but they're still going up to the order of say like 9 to 11%, which, if you have to do it for a year, fine, but you don't want to bake that into a long-term calculation. So I think you have a lot of folks making these judgments now saying, all right, well, I'm approaching the busiest time of the year in terms of rentals. Prices are up. Sales prices have recovered, but they're not going stratospheric. I mean, maybe in some of the luxury sectors, you're seeing some of these crazy prices, but in terms of that under 2 million market, it's not really recovering the same way that the luxury market has recovered. So I think you're seeing a lot of demand that just kind of keeps on coming. And I think it's also important to point out that, if you're looking at the number of contracts signed in April, it was a little bit less than March, and it was less than April last year and March last year. So there was 2021 was massive. I think 2022 is kind of coming back to earth. So I think we're seeing a little bit more of a normalization in this market, especially on the demand side. The supply side, I mean, it took us a long time to kind of get there, but we started building up supply. So, look, I think entering the summer period, which is typically a lull, and I think we're kind of getting back to that seasonal pattern. So we might have a quieter summer, we might have a busier fall, but we might be doing this in the context of a much broader supply pool. So I do feel like right now, if you're a buyer, you're sort of caught between, you still have a lot of competition and not a lot of things to choose from. But as you go into the summer, I think you're going to start seeing more things to choose from and slightly less competition. So I think that from the buyer's perspective, I think the market's going to be looking a little bit better going forward. From the renter's perspective, I don't think this market looks as good going forward. So I think if you're on the fence, the buying market for the next several months looks better than the rental market.
I would definitely agree with those sentiments and echo it. I think either way, there's going to be this, window, how long and how short, is it 3 months? And I want to pick up on a word that you used, normal and normalization. And I think as we've looked on all the charts, like, the question I ask myself, and I think you guys do as well, is what is truly the new normal, right? And we're in this new band of, demand and activity and how all these things, actually play in. And that slight drop off in activity is still seasonally, like I think with the charts that you guys have and built out so nicely there, still way above and trending way above kind of like those 10-year averages and things like that, even though it's off, of that 2021. So does that begin to hold and continue to hold in a reasonably okay supply market or even short supply in some areas? Or, I don't know that we'll ever go, I don't know that we'll go immediately back to the 2021 levels, but even if we hold at these levels, that I think still drives a lot of, demand in the marketplace. I think sellers have this window right now where, they can still capitalize because people know how hectic it's been. And we've been generally a little, better than the market, but even some seller or than the rest of the United States market. But even some sellers are starting to feel that pain, and locationally it's very dependent too. So we have some locations where, you know, I'm hearing every day, and like in Brooklyn, 3, 4, $500,000 over the asking price. And then, you know, other locations in East Harlem where, you know, certain things are just not able to move because it hasn't rolled into that yet. And we're probably still 12 months away, you know, from that happening in that market. So it's very locationally dependent too, is what we're seeing.
That's
Yeah,
awesome.
yeah, building by building and neighborhood by neighborhood, sector by sector, and just to look, this is great insights. All right, and I think all of us might, you know, a little bit of what John's saying is going to end up being correct, and what you're saying is going to be correct. You know, Ben, you mentioned in the beginning, the reurbanization, the comeback, and I think that is something for real, and I think it's early stage, and I don't think that's something that's going to go away. I think that's something that's going to just increase over time. And we've talked about this. I just didn't call it that way. John, we said full capacity. We're not at full capacity with Manhattan real estate, the buyers, the depth of our buyer demand. We're still missing all of these buyer categories that are usually in our market. And I think that ties into what Ben was saying. And I think that is going to play a role in what this market does over time as the commercial sector gets back online, as ground floor gets back online, as the foreign buyers. I mean, you got rents going up. You got rents going up. You got people still searching for yield out there. I wouldn't be surprised for investors to start getting interested in our market right now as these rental rates and the cap rates start to make more sense. This kind of thing, John, you mentioned this a year ago. You were so ahead of the curve, and you talked about this, how there's going to be a really good incentive cap rate wise once this rental market really gets going. And you were spot on with that call. And not only that, but look at where we came from in the last 3 years, and look at where other vertical markets in the national housing market went in the last 3 years. And I say this because, you know, we did not go up 30, 40, 50% in the last 3 years. You know, that we all know. Brooklyn did a little better than Manhattan, but Manhattan is barely at where we were 2018, 2019, because we fell. So I don't think we're going to have that violent reaction with the macro and the rates that other markets are going to be more susceptible to. I think the floor is going to be limited in our market if there's a corrective wave force, which I think is coming.
Good stuff.
Yeah, on the investment side, I think it's one of the most attractive times in Manhattan history as far as like the cap rates are concerned, at least since, you know, I've been in the business and really looking at cap rates. And we tried to tell people, as I think John, you know, had as well during the pandemic, like you can't look at the cap rate for today, but really like where the rents are going to go to and where you're buying it at today. And I think the more and more investors are seeing that, and now there's a track record and a history of that happening. You know, now you look at maybe something that's even a 4% cap rate because we're back at the 2018, 2019 price levels of, you know, to buy, right? But the rents are, you know, going up so significantly that, you know, if you say, well, if we kind of keep growing even at, you know, 7, 8, 9, 10% clip, you're looking for a AAA property that's easy to manage, you know, these doorman buildings, you know, potentially 5, 6, 7, you know, % cap rates if you're buying at today's dollars. I mean, that's unheard of for the, you know, level of risk. And it's just effectively like buying a AAA bond if you're to compare it to the bond market. So
right. Yeah. That's exactly right. John, this is great. Ben, great. Any final thoughts, Johnny?
No, I think Ben hit the nail on the head. I mean, you look at, if you're looking at the rental market from an investor's perspective, right? You're really essentially long duration because you want to, your inflation is going to wipe out all of your capital costs today because it's just going to inflate those costs away. So you're still, even cap rates given where they are, if you're looking forward 5 to 7 years, it actually looks pretty good.
Yeah, really good stuff. Excellent conversation. Very timely. Thank you, Ben Willig, sales manager over at Elegran. Thank you, John Walkup. I am Noah Rosenblatt. We're both from Urban Digs. We'll catch you next time.